Hello everyone, welcome to discussion sessions on official mock exam issued by ACCA for Advanced Audit and Assurance Level Exam for December 2025 exam attempt. I'm your tutor Owais Mirchawala, and in our today's class we will be discussing question number 1 of this exam paper. Discussion of complete exam papers is really important in finalization phase of your exam preparation because it gives you an idea that how you have to deal with all of the topics together in your actual examination. In my complete enrolled course, I have discussed almost 10 complete attempt exam papers, which give my students a great opportunity to improve their preparation. And this is the reason why more than 70 of my students have secured nationwide positions in the examinations which I offer, like ATX, AAA, and SBL. And in only the previous exam attempt of September 25 attempt, 12 of my students secured nationwide position. So these past paper discussion sessions are really important for your final exam preparation. And today we are looking at this official mock exam paper. I want you all to listen to me very carefully. If I just give you a brief of the approach which we'll be following, we'll be reading the complete question, like the introduction and all the exhibits. Complete thorough reading. Then we'll be discussing the points which we have to include in our answer. And then at last, we will be actually drafting the whole answer in this word processor document. So our today's class will be a very detailed class. Your patience and concentration throughout the class will be really important because it will be around 2 hour session in which we will completely draft this question number 1. In your actual examination, also for question number 1, you can spend around 1 hour and 45 minutes. Okay, since we will be discussing the points also, so we'll be taking 10-15 minutes extra as compared to your actual examination. But these discussion session will give you a real insight that how you have to draft each of the point. So without wasting further time, let's deep dive into the question. I want you all to listen to me carefully. So it is 1st July 20x5. You are an audit manager in Martin and Company, a firm of chartered certified accountants. See, this is the introduction screen of the question. Not very much relevant information. The examiner just introduce you that where you work, who is your client, and what are the exhibits given to you. Responsible for the audit of Carrigan Company, a listed company with a financial year ending 30th September 20x5. Carrigan Company is the country's leading retailer of electric goods, operating 251 stores across the country. The following exhibits available below provide the information relevant to the question. Exhibit 1 is partner email, an email which you have received from Megan Hall, the audit engagement partner, which we'll be reading. Normally in question number 1, in the exhibit 1, in the partner's email, he gives you the requirement along with the markings which you have to follow. Exhibit 2, background information, information and matters relevant to the audit plan. Exhibit 3 is selected financial information, extract from Carrigan Company management accounts, including the results of preliminary analytical procedures which have been performed by a member of the audit team. Then Exhibit 4, meeting notes, extract from the meeting notes taken at a recent meeting with the finance director of Carrigan. And then Exhibit 5, very important requirement for the recent exams because nowadays it's a very much trend to talk about sustainability, and ACCA is very much into these sustainability talks. Sustainability information request from the finance director regarding an additional engagement. The information should be used to answer the question requirement within your chosen response options. You all know that at AAA level, you have 2 response options. One is word processor, where you actually draft the points, and spreadsheet if you want to do any calculation or analysis. As we will be going forward in our today's class, we will be actually using these response options. So you need to listen to me with patience and concentration as we move forward. Okay, so let's look at it. I want you all to listen to me carefully. To audit manager from Megan Hall, audit engagement partner. Subject audit planning for Carrigan Company. Date is 1st July 20x5. See, this information is useful while you will be developing your answer because you also have to prepare the briefing notes. So this information is really useful. I will teach you when we will be drafting that how we form these formats of briefing notes and all. Okay. So with the year end approaching, I need you to start planning the audit of Carrigan Company. I met with the company's finance director Nia Ahmed last week to discuss recent developments for the business. Now wait a minute, some of the students may be thinking that sir, you are just reading the question. Like we can read it on your own also. See, I'm solving it just like you would be doing in the exam. Read it, look at the requirements, make the list of the points and actually draft the answer. Okay. So I'm not skipping any process or jumping the steps. We are just doing what you have to do in the examination. So listen with patience and concentration. I have provided you with a summary of the matters discussed at the meeting along with some projected financial information. Based on the analysis I have done on the industry, it is appropriate for overall materiality to be based on the company's profit before income taxes. Okay. See, you all know that as per the auditing standards, there are three benchmarks of the materiality. One is this profit before income tax, which we normally used to say profit before tax. As per IFRS 18, the name of profit before tax is changed to profit before income tax. It is the same thing, profit before the taxation thing. So one benchmark is profit before income tax. Second benchmark which we use is revenue, and third benchmark is asset. In question number 1 of audit planning, the examiner always specifies that which benchmark we have to use. So here he has specified that the benchmark which we have to use is profit before income tax. Now the range of materiality defined by the auditing standard based on profit before income tax is 5% to 10% of the profit. The range is 5% to 10%. Auditor has to use his judgment. Listen to me carefully. Auditor has to use his judgment to select the materiality level from this range based on the risk assessment. If the risk of the client will be high, auditor will go for a lower materiality level. Because lower the materiality level is, you will be doing more audit. Like, okay, everything above 5% is material. So you have to do more audit because your tolerance is only 5%. But if I keep this materiality level at 8% or 9%, so my tolerance level is increasing. Okay. So obviously we'll be taking a judgment and you have a professional skill mark of judgment to arrive at the materiality, as this is a key measure for investors and providers of the finance. So in this question, no talk about revenue and asset benchmark. We have been instructed to use profit before income tax as the benchmark. Using the information provided, I require you to prepare briefing notes for my use in which you evaluate. Part A, the significant business risk to be considered in planning the audit of Carrigan Company. Very predictable requirement in question number 1. Because either he gave us business risk and risk of material misstatement, or he goes for the audit risk. So business risk requirement 8 marks. If you have taken my classes and if you remember, the business risk which we draft in the examination hold up to 2 marks. So 2 marks for each business risk, you have to draft 4 business risk. And then part B, evaluate and prioritize the significant risk of material misstatement, ROM, to be considered in planning the audit. You will need to determine and apply an appropriate materiality threshold in your benchmark. Even if you would have not said this, we would have done this. Why? The reason being is that materiality benchmark was profit before income tax. Now we look at the range 5% to 10% of the PBT. Okay, the profit before income tax, we look at this range. We take our judgment and we select the appropriate threshold, the appropriate level, after which it will be material and below it, it will be immaterial. Like, okay, if the client will be high risk, we may select 5% threshold. If the client would be low risk, we may go for 10% threshold. So that we'll be doing, and obviously when we'll be solving the answer, we'll be looking at it at more detail. You should use Exhibit 1 to 4 when carrying out both the requested risk evaluation. This means that Exhibit 1, 2, 3, and 4, no reference to that sustainability exhibit. Okay, we'll do this. Then Part C, design the principal audit procedures to be performed in respect of the sale and leaseback arrangement. Again, a very predictable requirement at question number 1, risk and then procedures. Then comes part D, evaluate the matters to be considered in deciding whether Martin and Company should accept the engagement to provide advice on the Carrigan's company sustainability information. Factors to consider before accepting the engagement. Matters to be considered in whether deciding whether Martin Company should accept. So that factors to consider thing. 7 marks. Obviously, when we'll be solving it, we'll be looking at all of these things in a lot of detail. Okay. So we have read this partner email. We know that what we have to do. Okay. We know that, okay, part A is business risk. Then we have to talk about ROMM, then audit procedures and factors to consider. If you total up all of these requirements, 8 plus 18 is 26, and then 7, and then 7. So that brings the total to 40 marks. So we have heard that question number 1 is normally of 50 marks. Why the requirements here are only of 40 marks? If you remember the professional skill marks, you have to respond to the instructions in the email from the audit engagement partner for 40 marks. The split of the mark allocation was shown in Exhibit 1. Yes, we know the split. 10 additional marks. See, this 10 marks is not a separate requirement. You cannot attempt a requirement like giving heading. Part E, professional skill marks. No. Throughout the answer, while attempting the 40 marks, you have to demonstrate, display, show your skill of communication, like the format of the briefing paper, headings, proper wordings, analysis, financial analysis, non-financial analysis, analysis of accounting rules, analyze, evaluate, related to the scenario, both favor, against, develop arguments, professional skepticism, if there is any data which is incomplete or where any question need to be raised, or like when you're talking about factors to consider before accepting the engagement, like the sustainability thing. So you will be questioning the thing, skepticism, and your skill of judgment. Like for example, you will be taking the materiality judgment. You will be taking judgments in relation to accounting treatments. Your commercial acumen, like when you write business risk, you display your commercial acumen that, okay, you are aware of the business sense. All of these skills, while we will be drafting the answer, we will be demonstrating these skills. And if you remember, we have this complete class on professional skills. We had this complete class that how you have to deal with all of the skills. So 10 marks are additional. While attempting this entire answer, you have to display your professional skill. Done? So now, let's go forward. Let's read another exhibit. Okay. Let's read another exhibit, and as we move forward. Background information. Now we know that we have to talk about the business risk. We have to talk about risk of material misstatement. And then the procedures and the sustainability. Okay. So, Carrigan Company is a retailer established 15 years ago to meet growing demand for electronic goods. It is now the largest specialist retailer of consumer electronics and accessories in the country. Okay. The company operates 251 stores and employs about 7,000 staff. While most sales are off-the-shelf electronic products, like off-the-shelf means we don't make them. Okay, we get the branded products and we are just selling it. Smartphones, tablets, laptops, audio equipment, and off the shelf are those which are for general for everyone. Like we don't customize it for anyone. Some stores carry cutting edge or niche electronics, for example, high-end audio system or hobbyist drones, requiring staff to be trained in product feature usage and handling of delicate components. Some outlets sell specialized wireless devices subject to international radio and safety regulation. So see, he's telling us about the background of this Carrigan company. That they have been running since 15 years, have 251 stores, 7,000 staff members. Generally, they have off-the-shelf products like for everyone, no customization, okay, general products which anyone can just purchase and use it for himself. But we have some cutting edge technology products also. We have some wireless devices also on which the international radio and safety regulation apply. Like you know that on the drones there are regulatory restrictions. Similarly, on those walkie-talkies there are international regulations, or those radio signal encryptors, because sometimes they can catch the frequencies of the government agencies. Okay, so these are the products in which we are dealing in. Okay, so now as we move forward, most stores include a service and repair center staffed by qualified technicians who prepare repairs, diagnostic, and software updates. See, we are reading out the scenario, and obviously the business risks are coming in our mind also. Like, okay, when there is international radio and safety regulation, you can have a business risk that, okay, we may get involved in some non-compliance. Too many stores, 251 stores. The more your operations are scattered, it's more difficult to manage the business. But still, I haven't started writing the risk. I'm just reading it. I'm just picking up the points. Because when we move forward, we find more and more better risk also in the scenario. So more stores include a service and repair center staffed by qualified technicians who provide repair, diagnostic, and software updates. Customer can pay repair or buy an annual maintenance plan that covers routine maintenance and quarterly checkups, such as battery health checks, software updates, and minor repairs. The maintenance plan is very popular and historically accounted for about 10% of Carrigan Company annual sale revenue. The cost of the parts and technician labor had been rising, but management believes it would be uncompetitive to raise plan prices due to customer price sensitivity. So now see here there is also our business risk that a segment which was generating 10% of our sale revenue is facing a competition that we can't increase the selling price because the customers are price sensitive, they will switch to others, and our cost is increasing. Under the current accounting policy, the company recognizes revenue from sold maintenance plan at the date the plan commences. See, a wrong accounting treatment, it is an ROMM. A wrong accounting treatment, it is a risk of material misstatement. You cannot recognize revenue the date when you sold the plan. Just think about it. You cannot recognize the plan sale because, okay, the plan is for how many days? It's a yearly plan if you see. Customers can pay or they can buy an annual maintenance plan. So I sold an annual maintenance plan and I recognized entire revenue. So where is accrual concept? You have to record the revenue when you give the service. Revenue has to be recorded when it is realized, not when received. So they are following wrong accounting policy on recognizing the revenue of the plan. It's a very easy and a clear-cut accounting risk which is appearing in front of us. Okay, so we have read this first exhibit. As far as business risk are concerned, too many number of stores and a lot of staff they are employing, 251 staff, 251 stores and 7,000 staff. Okay, then their outlets have some specialized wireless devices on which international radio and safety regulations apply. So obviously there is a big risk that maybe staff sell some of the thing which is against the regulation and we may get a fine or a penalty or a cancellation of license. Then one of our segment which is generating 10% of the revenue is facing increased cost, but due to the competition we can't increase the price because the customers are price sensitive. And as far as the accounting risk is concerned, they are recognizing revenue too early. Okay, but still see, just wait and read the question, read the information, don't rush. You will find a lot of information. Selected financial information, extract from the management accounts of Carrigan for the year ended 30th September 20x5. Extract from the P&L. Revenue has increased from 745 million to 803 million. Operating profit increased from 110 to 172. Profit before taxes, profit before income tax has increased from 56 to 60. Obviously, you can do a good financial analysis also. Okay. Then we have total assets. Assets related to stores purchased from ACCA. Okay, what is asset? We'll look at it. It's note 1. Obviously, it's a current year acquisition. Then other intangible assets increased from 22 to 25. Receivables have increased a lot, 24 to 44. Cash is declining. Overtrading. Okay, receivables are increasing. You are making a lot of credit sales, but your cash balances are declining. Bank loan has increased a lot increase. Current ratio has improved. The gearing ratio has increased, but not too much. 31% gearing is acceptable range. See, in your examination also you first read, you gather up the data. The more you read, the more data is in your mind, you can do better and better drafting. Okay, notes. ACCA store acquisition. On 1st May 20x5, Carrigan Company bought 20 retail stores from ACCA. An electronic retailer in financial difficulty at a cost of $171 million paid in cash. Like a big burden, a big strain on cash. This is the reason why your cash balances have declined significantly. Okay, all stores will require a full refit to suit Carrigan format, estimated $9 million each. All stores. So this means 20 stores into $9 million. You are talking to me about $180 million investment. 20 stores into $9 million. Management has not decided how many of the 20 of these will be kept. Unused stores will be sold. See, here there is an accounting problem also. Those stores which you will be keeping with you will be accounted for under IAS 16 property, plant and equipment. But those which you will sell it or those on which you are not decided, they will be accounted for under IAS 40 investment property. Sold or not decided is investment property. Used in the business will be IAS 16. Planned refits will run from November 20x5 to January 20x6. Wait a minute, what's the year end? The year end is 30th September. Okay, on 30th of September, you have $36 million cash in hand. And you say, we will start refit on November and end on January. Like, how will you arrange the funds? How will you arrange the funds? Like $36 million can only refit 4 stores. You have 20 stores of ACCA. Other intangible assets relate to software and other technological development cost. During the year, $3 million was spent on developing a new IT system for dealing with customer inquiries and processing the orders. A further $3.5 million was spent on developing a new accounting software. These costs have been capitalized as an intangible asset and are all being amortized over a 15-year useful life. Like, I would say the risks are just coming up. They are just coming up. The examiner is throwing on us. We just have to catch them. Like, just think. We spent $3 million. We spent $3.5 million. We capitalized all of them. Do you follow IAS 38? Research and development. Initial outlays are research, then development, then IAS 38 criteria. Economic feasibility, economic viability, technical viability, okay, ability to use or sell. They are capitalizing all of that. And then following same 15-year life on all of the things. Like every intangible will have its own life. So capitalization of intangible outflows. Okay, these are accounting risks. Trade receivable. Most of the Carrigan sales are cash. But an increasing number of business customers purchase a 60-day credit. In December 20x4, Carrigan engaged Recover Company, an accounting service provider, to handle the credit control function. Recover is an external service organization. We engaged it in December 20x4. Our year end is September 20x5. But despite of that, just look at the receivable balance. Like, it has almost doubled. The more receivable you hold, there's a more risk of bad debt. And obviously a strain on your cash. Okay. So we are just reading it. See, I haven't done a deep dive. I'm just gathering the data. My mind is getting the things. Okay. It's really important that you read the information, because more you read, the more data is in your mind and you can draft better points. Now, Exhibit 4. The group established an equity settled share-based payment plan for its executives on 1st October 20x4. 250 executives and senior managers have received 100 share options each, which vest on 30th of September 20x7. Okay, so launched on 20x4 to 30th September 20x7, 20x4 to 20x5, 1 year, then x6 and x7. A 3-year plan. A 3-year plan of 100 share option each given to 250 executives, talking about IFRS 2. If the executive remain in the employment at that date, and if the carrying company share price increases by 10%. No expense has been recognized this year, as Carrigan company share price has fallen by 5%. And so it is felt that the condition relating to the share price will not be met this year. Wait a minute. Maybe it's not met this year end. But the point is that we have to talk about the increase over the period of 3 years. 10% per annum. So maybe in the 3rd year it increases by 30%. So as per IFRS 2, we have to look at the probability, like, okay, what's the probability of the conditions getting satisfied? And that's not at the current year end. You see that, okay, what is the probability that at the maturity, the conditions will be satisfied? So taking the decision on current year end only is not the right approach. Okay. They have to think over the life of the plan. They have to think over the life of the plan. Maybe in the 3-year period, we get an average increase of 10% per annum. So we should have recorded the expense. Like they haven't recorded the expense completely. That's wrong. And okay, maybe you don't record it, but the point is that you don't just look at the current year end. You look at overall life of the plan. Okay. Now, obviously, this is an accounting risk, IFRS 2. Okay. I hope that you all have studied SBR in your previous examinations. And obviously, in my course, I have given you the revision of different accounting standards also. Okay. Now, on 31st March 20x5, Carrigan Company sold a property to a lease company, Cold Company, for a fair value at the date. The property is situated in a sought after area with a high demand for rental property for retail purposes. Coal Company has assessed the remaining life of the property to be more than 50 years, and under the terms of sales agreement, Carrigan will lease the property back from Coal Company for a period of 10 years. We have sold it and we have just taken it back for a period of 10 years. This means that it is not coming to us for the majority of the life, because the life is more than 50 years and we are just taking it back for 10 years. So it's a sale. First, we will record the sale, and then we will recognize a right to use asset of 10 years. Carrigan Company has treated the transaction as sale and leaseback transaction in accordance with IFRS 16, de-recognized the property in its financial statement, and recorded a sale with IFRS 15 revenue from contract with the customers. Okay. See, IFRS 15 conditions need to be satisfied of the sale. If those conditions are satisfied, you record the disposal of the asset. Okay. Okay, they recorded the disposal, they have shown it. The point is that what about the right to use asset? Because you have a right to use asset of 10 years. So apparently they haven't recorded the right to use asset, because they said that in accordance with IFRS 16 leases, they de-recognize the property. Okay. Now, and they recorded a sale. Fair enough, they recorded a sale because IFRS 16 gives reference to IFRS 15 revenue. That you have to look at IFRS 15, that whether the conditions of the sale are recognized or not. So yes, the condition of sale is met because we haven't taken the property for majority of the life. 50 years was the remaining life and we just took it for 10 years. So sale need to be recorded, but at the same time, a right to use asset for 10 years also need to be recognized. Again, this is the detailed accounting issue we'll be looking at when we'll be drafting the answer. Then Carrigan Company has launched a line of premium electronics under its own brand, the Carrigan range, including smartphones and matching accessories. These products are manufactured in another country and imported. A business risk. Purchases of Carrigan goods brand from foreign supplier predicted to be $7 million for the year end. The brand was introduced in June 20X5 with heavy marketing. Being newly introduced, the sales are very minimal. However, management forecast to assume that Carrigan range will account for about 30% of the total revenue in the year to 30th September 20X6. So again, since you are launching a new range, so obviously there's a business risk that it won't be successful. Then you are importing the goods. So you are getting yourself exposed to the exchange rate risk, risk of delays in transit and all. Okay. Then, during the year, the Carrigan Company arranged an additional bank loan to support the launch of new Carrigan range and the planned refitting of the stores from ACCA Company. See, when I look at this entire scenario, what I feel internally is that Carrigan Company was in a lot of rush this year. They acquired ACCA Company, a big cash outflow. They launched their own range, Carrigan range. Now they plan to refurbish a lot of stores in the next 3 months. Their cash balances are declining. Bank loan has increased. Sold a property, went for lease back. Receivables are increasing. So apparently the cash flow position is also not very good. So now, Exhibit 5 is for a separate requirement. Okay, it's for a separate requirement. We are not looking at that because the requirement clearly said that we just have to focus on Exhibit 1 to 4 currently. So now, obviously, we'll deep dive into all of the things, but you need to listen to me very carefully. Okay. Now, our client is Carrigan Company, on which we are talking. Okay. Our client is Carrigan Company. Okay. And we have to prepare the format of briefing notes. So just listen to me. Briefing notes we are preparing. Okay. Now, whenever you have to prepare these formats at AAA level, what you have to do? Just go and copy the data from here. Listen to me. Copy this thing, these 4 lines. Copy it. That's very much normal. You have to prepare briefing notes. Now you copy these 4 lines from here. Okay. You copy this. Copy. You go on the word processor and you paste it. Just break up the lines. Learn the approach. Learn the approach. Okay. Now what you will do? See, now you are responding. In the question, Megan Hall sent you an email. Now you are responding to Megan Hall. So what you will do is you will just switch the sign. I will copy this, cut it, and then I will paste it here. And here I will cut it and I will paste it here. I've just switched the sign. It was to Audit Manager. So now it is from Audit Manager. It was from Megan Hall. So now it is to Megan Hall. In the subject, I will add RE, reply. I am responding back. The date remains the same. Done. Now you will add an introduction. These briefing notes, standard introduction. These briefing notes are in relation to audit planning of Carrigan Company for the year ended. What is the year end? What is the year end? If you go and look at it, I think he gave us the year end. The year end is 30th September 20X5. Okay. We are talking about the year end of 30th September 20X5. If you don't remember, you can just go to the introduction screen also. And you can find that we are talking about the year end of 30th September 20X5. So for the year end, 30th September 20X5. 20X5. Okay, it includes evaluation of. See, learn the approach. This is very much important. Just a second. Sometimes the screen misbehaves. Okay, so now, and this is the reason why it's very important that you practice some papers on the platform so that you don't get annoyed when these things happen. So it includes evaluation of what? Just go and look at the requirements. Now you have to refer each of the requirements. First requirement is to evaluate the significant business risk. So it includes evaluation of significant business risks to be considered in planning the audit of Carrigan company. See, in the introduction, you first give reference of the company and its year end. That these briefing notes are in relation to audit planning of Carrigan company for the year ended this. Now you will refer each of the requirement. Which requirement? It includes significant business risk to be considered. Part A. Then further, it also includes evaluation of what? Just go and look at the requirement. Evaluation of significant risk of material misstatement to be considered. It also includes evaluation of significant risks of material misstatement to be considered. Okay. It also covers what? The third requirement. It also covers principal audit procedures to be performed in respect of sale and leaseback. I copied it from here and then I pasted it. Principal audit procedures to be performed in respect of sale and leaseback transaction. Lastly, it includes what? Go to here. Lastly, it includes the matters to be considered in deciding whether Martin and Company, our firm, should accept the engagement. And I will go and paste it here. The matters to be considered in deciding whether our firm should accept the engagement to provide advice on Carrigan Company's sustainability information. Here you go. Your entire introduction is done. I will repeat the things again. We are preparing briefing notes to, from, date and subject. You pick it from the partner's email itself. For the introduction, a brief statement. These briefing notes are in relation to audit planning of name of the client, Carrigan Company. For the year end, pick it up from the question, 30th September 20x5. And then you refer each of the requirement briefly. It includes evaluation of significant business risk of material misstatement, principal audit procedures, and matters to be considered in deciding whether our firm should accept the engagement. I believe it's not difficult till here. It's just following the approach. The more you practice, the more you understand the approach. Now comes part A, business risk. This is what we have to attempt. Part A is business risk for 8 marks. Here you go. Part A, business risk. So now you have made the format of the question. Now you will list down business risk. Sir, each business risk worth 8 marks. Each business risk worth 2 marks. Total are 8 marks. So 8 marks divided by 2 marks for each business risk. I just have to write 4 risks. And while writing the business risk, what approach we follow? Identify the risk. Like which information is triggering that risk. Identify the risk. What impact that risk may have. And then comment on scale of the risk, on intensity of the risk. 3 to 4 sentences. 3 to 4 sentences on each risk. See, in the examination, you don't have unlimited time. You have to solve the paper in limited time. Okay, so following the approach is really important. So let's look at the risk and let's graph them. So if you look at the scenario, I would say there were a lot of easy business risks. Like even if I look at the background information, the company is operating 251 stores, employing 7,000 staff members. a lot of electronic products. You know that electronic products have a generic business risk also of short life cycle because they keep on getting obsolete. Like, smartphones, laptops, a big inventory they are managing with a heavy risk of getting obsolete. Okay. Then they are selling some products which are subject to international radio and safety regulations. Okay. So I would say spreaded operations. Okay. Too much spreaded operations like 250 stores and 7,000 staff members, heavy risk of obsolescence. I'm just making a list and then I'll select the important ones. Too much spreaded operations. Then similarly, exposure to international regulations for the sophisticated products which they are selling. If you look at it, they are selling these wireless devices subject to international radio regulations, radio and safety regulation. Then, if you look at this repair segment, the cost of the parts and technician labor have been rising, but management believes it would be uncompetitive to raise plans. Okay, so competitive pressure on repair segment, which represent 10% of your revenue. Then the cost is increasing, but then also you are not able to increase the prices. Then obviously this was an accounting risk, that how they recognize revenue, that's a separate thing. We'll be looking at it in risk of material misstatement. So we read this first exhibit. I'm just putting up the business risk which we identified. Now if you go and look at exhibit number 2, entire financial data which was provided. So if you scroll it down and you go and look at this ACCA store acquisition, outlay of $171 million, then no decision that how many stores they have to manage it. Like, okay, you spent $171 million without a clear strategy. Now you want that, okay, we'll spend $9 million each. So you need $180 million because it's 20 stores and you have just 36 in your bank account. Like, you won't spend entire on these stores only. So won't you run your regular operations? And then just look at the deadline, November 20x5 to January 20x6. So acquisition of ACCA, what I particularly feel is that it was not a planned acquisition. They just did it out of blue. They didn't plan it. Okay. Then obviously these intangible assets, this is an accounting risk, that how they are capitalizing it and how they are amortizing it, because they can't capitalize whole of the spend amount. Then you look at receivables, they are increasing significantly. Okay, like I would say that we should write a point on liquidity also, because cash balances have declined, debt is increasing, receivables are increasing. Okay, liquidity risk, because apparently their debtors are increasing a lot, so there is a great risk of bad debt. Already cash balances are very low, they are at a declining trend. Okay, so we have read all of these things. Then if you look at this information, equity settle thing, it's obviously an accounting risk that they are not recognizing the expense. Sale and lease back is also an accounting issue. These are complete accounting issues. Now comes the Carrigan range in which they are importing the things. So Carrigan range, it is a big issue because they have launched this new brand. Cash flows are tight. You need to do heavy marketing and you are doing a new thing. And already you are at a lot of over trading thing. Okay. This Carrigan range which they have suddenly launched. So that also exposes them to a business risk. And then obviously they are reliant on the bank loan to support the new launch and all things. So we have already written that they have this liquidity risk and they have this exposure of getting involved in a lot of things. Okay, so if you look at all of these exhibits, like you had to write 4 business risk. Too much spreaded operations. Okay, then exposure to international regulations. Okay, exposure to international regulations. Then maybe you sell anything which is not permitted as per the international law because you are selling these sophisticated equipment, competitive pressure on repair segment, acquisition of asset, liquidity risk, carrying range. So I would say that 6 business risks were available without any much effort. Like these were just standing in front of us, like too many stores and selling those products which have a short life cycle. These safety regulation thing, customers are price sensitive, we can't increase the price. Then this new segment which they launched, they don't have a clear plan. Okay. Then liquidity risk, obviously cash balances are declining, receivable is increasing, reliant on bank loan and the carrying range. So now from these 6 business risks, you have to write any 4 of them. You have to write any 4 of them because it's 8 marks. Okay. So if I see, you can write any 4. First, keep it in that mind. But since I have to go for significant risk, I would indeed refer this acquisition of ACID because that's a big investment they have done of like 171 million. Then the carrying range also I will indeed cover because that will represent 30% of the revenue in the next years. Okay. Then you can talk on competitive pressure thing, you can talk on liquidity risk, you can talk on too much spreaded operation. See, try to cover the important ones mandatory. Otherwise, it's your choice, you can cover any 4 risks. Now, good thing was that in marking scheme, all 6 were included. So if anyone would have written any 4 of them, like if you would have not written these 2 and written these 4 only, that would also be acceptable. But what you have to try in the examination, that always go for the significant risks, like the bigger ones. So acquisition of ACID, this is the first risk on which I'm talking. Let's identify the risk. Let's identify the risk. Investment of $171 million. Okay. No decision of how many stores have to be refurbed. 20 stores refurbishment will require $180 million. 20 stores into 9 million. We have only 36 million in our bank. Total 36. We can't spend that entire 36. So apparently this ACID store acquisition was not a planned investment they have done. Okay. And then the refit plan from November 20x5 to January 20x6. You currently stand at September. Your projected cash flow is only 36. Like, okay, will you get any treasure from the ground? How will you manage that? So acquisition of ACID, first identify the risk, then talk about its impact, that what impact it can have, and then comment on its evaluation or scale of the risk, that why this risk is becoming a significant risk or something like that. Okay, so acquisition of ACID business during the year, during 20x5, appears to be an unplanned investment, as a Caribbean company made this investment without a clear plan that how many of ACID stores will be refurbished and how funds will be arranged for it. Okay, so first I identified the receipt. Please learn the approach. Even though I have taught this approach multiple times when we were studying these topics. But again, what happened in your actual exam is that since there are a lot of requirements together, you forget the drafting approach and then you just go haphazard. When you go haphazard, there are 2 impacts. You write too much and waste your time. And you write useless, not what the examiner is expecting. Always in the business risk, see, every answer has an approach. Approach of ROMM is completely different. Approach of business risk is completely different. Acquisition of ACID business during 20x5 appears to be an unplanned investment, as Caribbean company made this investment without a clear plan that how many of ACID stores will be refurbished and how funds will be arranged for it. You identified the risk. Impact. If investment is not managed in proper manner, then inventory of ACID stores may get obsolete in that time, and additionally ACID stores will lose further goodwill in the market due to lack of service despite of being acquired by a Carrigan company. So your investment will suffer. If you will not manage it, further losses, your inventory will go obsolete. And obviously the stores must be open because it was an ongoing business. It was a going concern business. It was not a seized business which we have acquired. Okay. It was a retailer in difficulty. It was an ongoing business. Either you will close the shutters, close the stores. Obviously, that's not what you want. Okay. Now, how this risk becomes more significant? Plans to refurbish stores till January 2026 is an optimistic plan of Carrigan Company, as at year end of 30th September 20x5, they don't hold sufficient funds to even refurbish. They don't hold sufficient funds to refurbish a lot of stores. Maximum refurbishment done that can be done with whole cash flow is 4 stores, as they have $36 million cash in hand at year end only. Okay. See, understand that how I'm writing it. First, I identified the risk. Look at it. That okay, the investment was done in unplanned manner. It wasn't a good investment. But we are talking about business risk, not an accounting thing. We are talking about the business. What will happen if the investment don't go in a planned manner? If the investment is not managed, it's not planned, the inventory which ACCA is holding, that will be obsolete. The stores will suffer more. And then you evaluate. See, many students message me that we are not able to write evaluation or scale of the risk. When I talk about evaluation or scale of the risk, look at the scenario. Any information which is related to your risk which you just identified, like plans to refurbish, are optimistic. They are unrealistic. Like in 3 months only you will complete the refurb. You stand at 30th September, you have $36 million. If you spend entire of your cash flow also, you can only refurb 4 stores. Because it's $9 million for 1 store. So 36 million, it's only 4 stores. 9, 18, 27 and 36. Done. So will you close your operations without cash flow? Okay. So when you talk about the scale of the risk or the intensity of the risk, any comment which make that risk more critical, more important, more significant, the investment is not done in a well-managed manner. That, let's look further. Look at another risk. Carrigan range. See, the Carrigan range was launched during the year. Obviously, it's a new range, so it holds a risk that it may not be successful. Then you are importing it. Exchange rate risk, delays in delivery, which we call as lead time. Okay, we introduced in June. We did heavy marketing. Sales at year end were minimal, but okay, management is optimistic to get 30% sales. Okay, launch of new range of products under Carrigan brand name holds a risk that it may not be successful, and Carrigan company may not be able to get sufficient sales due to lack of success or due to liquidity issues it is facing. Okay, may not be able to get sufficient sales due to lack of experience of running its own brand. Because till now you were not running your own brand. Okay, what you were doing is that you were selling other people's products. Or you can also refer it like, okay, due to cash flow issues, because you don't have sufficient cash flow, you are relying on bank loan. And okay, bank money is not your money. Maybe they give, maybe they don't give. They will put a lot of covenants also. Okay. If Carrigan brand is not successful, then inventory in relation to it will be at risk, as electronic products have short life cycle due to technological changes. Additionally, amounts spent on marketing will also be wasted. Identify impact. What will happen? Scale of the risk. Products of Carrigan range are being imported, which further increases risk due to fluctuation or adverse change of exchange rate and delays in delivery due to uncontrollable foreign or transport factors, okay, due to weather or something like that. Or maybe some import duties are imposed by the government, because you all know that imported products are not liked by any government. So if you look at the drafting, first you identify lack of experience, new brand, cash flow issues. Then brand may not be successful, so your products will get wasted. Amount spent on marketing will be wasted. Products are being imported. Okay. You can also write one more evaluation. Okay. As this brand is being supported through bank loan, failure of its success, failure of its brand, of it will create burden on existing operations, as bank will demand its funds irrespective of brand success. Okay, if it would be your own money, you would have said, okay, I can take the risk. But it's not your own money, it's the bank money. Too much spreaded operations. Carrigan company operations are too much spread, have a too much spread, as they have 251 stores, if I'm not wrong. Yeah, as they have 251 stores, and 7,000 staff members. Okay. It is difficult to manage too much volume of business. Okay. They hold inventory of electronic products which already have a risk, of technological obsolescence. Okay, if Carrigan company is not able to manage its operations well, it may suffer inventory losses. Okay, risk is further high as they have weak liquidity position in current year end due to too much expansions they have done and they have planned. Okay, acquisition of ACCA stores, ACCA brand and new Carrigan range will further increase pressure on management of Carrigan company. See, the more you expand, obviously the more you have the risk. Already 251 stores, 7,000 staff members, a lot of inventory items. Then weak liquidity. Okay. Then further acquisitions. So you are talking about business risk. 2 marks for each risk. See, don't write like 10 line risk. Identify, impact, scale. 3 sentences are minimum. Sometimes write 4 sentences. That's all. Okay. Then exposure to international regulations, like you can talk about this, the radio safety products which they are selling. Then competitive pressure on their repair segment. I like that risk more. So I would prefer writing that one. Okay, but you can write this international regulation, or you can write on liquidity also, because cash balances are declining, bank loan is increasing, receivable is increasing. Relying on bank loan for your operations like Carrigan Range, ACID, that's always risky because bank is not your friend always. Okay. Now, repair segment of Carrigan Company is facing pressure due to increasing costs and inability to increase selling price due to customer price sensitivity, creates a risk that this operation may suffer declining margins, or I would say losses in future periods. Okay. If repair segment is if Carrigan Company is not able to manage its cost or increase selling price, then this segment may suffer losses. Additionally, if this repair segment is discontinued, it may affect sale of their electronic products also. See, because just think practically. Whenever I purchase anything from any electronic store, what I expect? I expect that, okay, they will give me support also, like after sales support. And for that, they need to have a repair segment. And the repair segment is currently suffering. Okay. Repair segment represents 10% of Carrigan Company revenue. And therefore, it holds significant risk if it is discontinued or its profit margins decline. Okay, competitors may use repair service as a tool to gain customer loyalty. See, that's very much logical. You go to some other store to get your thing repaired and they'll say, okay, you purchase it from there. No. This product is not good. Next time you should come to us. We'll give you a better thing. It's the normal business practice. So now we made the format of the briefing notes. We wrote introduction and we wrote 4 business risks as they were required for 8 marks. Done. Now comes the second requirement, which is in relation to significant risk of material misstatement. Okay, so let's talk about that. Significant risks of material misstatement. Part B. Okay, so now let's talk on this. We are done with this first part, which was in relation to business risk, and now we are talking about significant risk of material misstatement. You all know that whenever we are talking about risk of material misstatement, we will add a paragraph on materiality level. It's normal. ROMM and audit risk. ROMM and audit risk. Always add a paragraph on materiality level. Not for business risk. ROMM and audit risk. Always write a paragraph on materiality level that holds 2 marks. That holds how many marks? 2 marks. So now this requirement is of 18 marks. 2 marks will go for materiality level. You have how many marks remaining? You have remaining 16 marks. So you can write like 5 risks, because in accounting, every risk can hold up to 3 marks. Okay. And if you do some calculations like upper range of materiality, lower range of materiality, you get 0.5 mark for each calculation also. So now let's talk on this materiality level and then 5 risk in relation to ROM. Okay, so now we are talking about risk of material misstatement. The first paragraph will be about materiality level and then different risk of material misstatement, which we can draft in this answer. So I believe there were some very good ROMM in this question. First of all, in relation to revenue recognition for the maintenance plans, like they record the plan when the plan is commenced. Okay, so recognition of revenue for repair plans. Okay, so that is the risk and a misstatement which they are doing, because you cannot recognize the revenue when the plan commences. See, we are currently in audit planning phase. So whatever issues we identify, even though it's an actual wrong treatment, we consider it as a risk for our audit activity. Because during audit, we will specially focus on these areas. Because some students argue with me that, sir, it's an actual wrong treatment. So why are you showing it as a risk? See, at planning phase, you don't start doing the actual audit. At planning phase, you mark these wrong treatments or possible wrong treatments as the risk on which you have to do greater audit work. Okay. Then similarly, if you remember the financial information segment, this treatment of the 20 stores, management has not decided that how many of the 20 stores to keep. Unused stores will be sold. So recognition of stores of asset stores, because some stores will be recognized under IS 40 investment property if they are to be sold, or for them we are not decided. Only those for which we are decided, we can recognize them as IS 16 property, plant and equipment. Then this intangible asset thing, where whatever they are spending, $3 million spent on developing, $3.5 million spent on developing, they're not looking at the criteria. Whatever they spend, they directly capitalize it. And then they are amortizing it over 15-year useful life for all of them. Okay. So intangible asset. See, these all are the big risks. I'm not going in small risks. Like, okay, since it's smartphones and technology products, so inventory obsolescence is also a risk. So valuation of inventory can also be written as a risk. But I'm not going in small areas. I'm just picking up the major ones for which clear information is given. Similarly, you can write a risk on trade receivable allowances also. You can make analytical review also, like the ratio analysis. But still, I would say there was some good risk, like similarly in relation to the share-based payment, you can have a good risk. Okay, share-based payment. Then a risk on this sale and lease back. So I would say that there was some very clear risk in this question. Okay. For this Carrigan range also, you can have a risk that, okay, if they are importing the material, there's an issue relating to exchange rate. Okay, you can write that also. Similarly, they are using the loan to do the refitting of the store. So you can talk about IS 23 thing also, like borrowing cost thing also. But since we had 18 marks only, so 2 marks for materiality, then you get some marks for calculation also, like upper range, lower range, the values which you calculate. And then we will be discussing these 5 very clear and significant risks which were standing in front of you in the question. Okay. So let's start with it. I want you all to listen to me carefully while we draft it. For a lot of things, you need to understand the approach that how you have to write them. So for materiality level for Carrigan Company audit will be based on benchmark of profit before income tax. Why? Because if you remember in the exhibit 1, the partner's email, it was written that we have to base our materiality on the benchmark of profit before income tax. Okay. So will be based on benchmark of profit before tax, profit before income tax, materiality level range will be between 5% to 10% of profit before income tax. Okay, our firm will have to use professional judgment to determine materiality level from this range based on risk assessment of Carrigan Company audit. See, these are standard statements which you use. The benchmark is based on profit before income tax. It's stated in the question. The range of materiality is given by the auditing standard. Then a standard statement that we use professional judgment to determine materiality level from this range. Now, range of materiality level will be between what? If you look at their profit before income tax, it's $60 million. So 5% will be 3 million and 10% will be 6 million. 10% will be 6 and 5% will be $3 million. Will be between $3 million to $6 million. Okay. Now, if you look at Carrigan Company audit, see, the question is silent that whether it's our new client or not. Okay, it just stated when the year end approaching, I need you to start planning the audit. And even if you look at the introduction screen, there is nothing written that it's our new client. You are audit manager, firm of chartered certified accountant responsible for the audit of Carrigan, a listed company with year end of 30th September. The question is silent that whether it's our new client or an existing client. When the question is silent, we assume it as our existing client. I've always said it's our existing client. So when it is our existing client, our risk is lower because we already know about the client. The risk is lower, but it's a listed entity, increases the risk. And then if you look at the client as a whole, there are a lot of things happening like wrong revenue recognition policy, acquisition of stores, intangible asset things, share-based payments. So there are a lot of risky transactions where there are a lot of questionable transactions involved. Now, as Carrigan Company is an existing audit client of our firm, therefore, risk is lower from this perspective. However, it is a listed entity which increases risk as it will have greater regulatory supervision. Obviously, when you are listed, there are watchdogs, people looking at you, the Security Exchange Commission, because you are listed on the stock market. Okay. But the major thing to consider is, as during the year, major transactions are done in relation to acquisition of ACID company or of ACID business, launch of new brand chain of Carrigan, and share-based payments during the year. Risk of audit is higher. Okay, because there are a lot of things happening. Like you acquired a big business for which you are not decided. You launched your own brand chain. There is share-based payment. You entered in sale and lease back. Okay. Considering higher risk of audit, lower level of materiality will be used for Carrigan Company audit, and it will be $3 million. So can you repeat it again? Yes, I will repeat. See, for materiality level, the entire comment holds 2 marks. First of all, you followed the instruction of profit before income tax, you referred the range. Then this calculation, 3 million and 6 million, you picked up the profit and you did the calculation. So that each calculation hold 0.5 mark each, because this 3 million and 6 million was not in the question. The question gave you profit before income tax of 60 million. You applied 10% and you applied 5%. Okay. Then You formed a comment that, okay, it's an existing client, so risk is lower from this perspective. However, it's a listed entity which increased risk. During the year, there are a lot of transactions involved which also increase the risk. And considering higher risk, you go for lower materiality level so that you do more detailed audit. Like your tolerance level is reducing. Okay. So this judgment that, okay, what materiality level I will be using, it gains mark in professional skill of judgment. Okay. So first of all, 2 marks for overall comment. Then a mark in communication skill for following the instruction. Mark in judgment skill for taking this judgment. 0.5 mark here and 0.5 mark here for the calculation. So what I believe is that a good materiality level paragraph can gain up to 4 marks in total. 2 marks first of all in technical skill for making this comment, like out of 18 marks you get 2 marks for making this comment. 1 mark for calculation, 0.5 and 0.5. And then professional skills also for following the instruction, shows good communication, taking the judgment. Okay. Now let's write each of the risks. Okay, let's write each of the accounting risks. See, when you are writing these accounting issues, they hold up to 3 marks. You write correct treatment, you comment on the management, you tell the heads affected, and you comment on materiality. Each business risk was of 2 marks. But when you talk about risk of material misstatement, these accounting issues can hold up to 3 marks. See, what they are doing. Under the current accounting policy, the company recognizes revenue from sole maintenance plans at the date the plan commences. This is wrong. Okay. So first of all, let's write the correct treatment. Carrigan company should spread the revenue of annual maintenance plans over 12 months period as its service is being provided over the year. This is the correct treatment, what they should be doing. Currently, management recognizes entire revenue at the start of the plan. Okay, it is a wrong accounting treatment as they are recognizing revenue when complete service, or I would say when service is not being provided for it. I'm not saying that you recognize it at the end. I'm saying it recognize over 12 months. Like whatever amount you are getting, you divide it by 12 and every month you recognize the revenue. Like month by month. Till the year end, whatever months have been done, you recognize the revenue of that. You shouldn't be recognizing entire revenue at the start of the plan. This is a wrong accounting treatment. Okay. Management is overstating revenue and understating its deferred income liability. Because when you receive the amount, you have to recognize it as a deferred income. And then over the period, you shift it from deferred income to the revenue account. So they have currently recognized entire revenue, which is overstating the revenue, and it is understating the deferred income liability. Now, if you remember, this represents 10% of the revenue. And the revenue, if you look at the business revenue, that's 803 million. So 10% would be like $80 million. Okay. This issue is material to financial statement as it represents 10% of Carrigan company revenue, which equals to a value of $80.3 million, because your actual revenue is 803 million. So 10% would be like $80 million. Okay. It exceeds the determined materiality level for audit. Okay. We don't exactly know that how much is unearned. We don't know that, okay, how many months are remaining, because we are not provided with each contract data. But if I talk about the overall issue, it's a big matter. 10% of total revenue. So $80.3 million it represents. Okay. So the correct treatment, they have to spread it. comment on the management, they are not doing it, what heads it is affecting, and you comment on materiality. See, 3 marks are given for this much. You have to follow the approach. Right treatment, comment, and heads affected. Now, recognition of asset stores. If you look at it, management has not decided that how many of the 20 stores will be kept. Unused stores will be sold. So as per the accounting standards, stores which they will be keeping will be treated under IAS 16, and stores which they will be selling or they are not yet decided, they have to value them under IAS 40. Each accounting standard has its own treatment. Okay. Now, carrying company has to account for stores or has to apply IAS 16 property, plant and equipment on stores which it will keep for its business. For its business, carrying company has to apply IAS 16 property, plant and equipment on asset stores which it will keep for its business. Those stores which will be sold, or for those it is not yet decided, it should apply IAS 40 investment property. And you know that both of the standards have completely different treatments. IAS 16 is costless depreciation, whereas IAS 40 investment property can have fair value through P&L or the cost model. So you need to determine it. Currently, we don't know that where they have recognized. They have just included it in total assets. Okay. As per IAS 16, stores will be normally valued at cost less depreciation, whereas under IAS 40, either cost model or fair value through P&L model, through profit and loss model would be used. Obviously, I won't go in a lot of detail of accounting of IAS 16 and IAS 40 like revaluation model and everything. It's a 3 marks point, not a 30 marks point. Okay. Currently, management of carrying company has not yet divided or decided in relation to stores, and therefore it may lead to wrong accounting treatment being applied on them. Okay. This will affect presentation and valuation of these stores. See, because if they are property, plant and equipment, you show in the relevant head in balance sheet. Even though both are non-current asset, but one is property, plant and equipment, other is investment property. Okay. Stores represent how much? If you go and look at it, the asset stores represent $171 million. So it's obviously material to FS. Stores represent $171 million, which is material to financial statement as it exceeds materiality level of $3 million determined for Carrigan Company audit. Like, I think that it's very easy. Like, this mock is just a confidence booster. And it's not like that they have intentionally made it like that. It's a past paper which they have put it in the mock exam. Then intangible asset. Okay. What they are doing is that they are amortizing all intangible assets at 15 years. They are capitalizing the entire amount they have spent. It don't work like that. Amount spent on research and development of softwares by Carrigan Company can only be capitalized if it satisfies capitalization criteria of IAS 38. If you remember the accounting standard number, you write that. Otherwise, you can just skip and say criteria of intangible asset standard, if it satisfies capitalization criteria of IAS 38. Otherwise, outflows should be expensed out. Initial outflows are generally not capitalized as they do not satisfy the criteria. Because initially, obviously, there is no viability, feasibility, and everything. Okay, of viability and feasibility of the project. Okay, now Carrigan Company is capitalizing entire spent amount, which is a wrong treatment. Okay, this will overstate intangible assets and profits of the company, because instead of expensing it out, you are recording them as asset. Amounts capitalized worth how much? 3 million and 3.5 million. 3 and 3.5, whatever they spent. Amount capitalized worth $6.5 million exceed materiality level of $3 million. We are self-determined. Okay, it's written here. Therefore, material to financial statement. Okay. Now, if you want, you can comment on amortization also. Additionally, but a brief comment. Both intangible assets or all, if I'm not wrong, let's look at it. All being amortized. Additionally, all intangible assets are being amortized at 15 years life. This is also wrong, as each intangible asset should be amortized according to its own respective life, not a single life for everything. I believe very easy risk and very absolute ones. Then share-based payment. If you remember IFRS 2, you have to look at the probability of the plan getting vested over its tenure, not just looking at the current year end. Like based on current year end, you said, okay, they won't vest and I won't recognize expense. That's wrong. Okay. So, Carrigan Company should estimate probability of the share plan getting vested over its plan period and then spread its expense over the vesting period. Okay, they have to look at the probability. If you remember IFRS 2, okay. Currently, management has not recognized plan expense at current year end based on assumption or based on claim that share price target is not met at current year. It's wrong, as target has to be met on final maturity date, of increase of share price increase of 10% per year. Maybe at the third year end it increases by like 40%. So the targets will get satisfied. So you have to look at the probability over the plan period, not at the current year. Failure to recognize expense will overstate profits and understate equity settled plan reserve, because equity settled plans are recorded in the equity directly. Expense on the debit or on the credit, you record the equity. So we currently don't know the value of the plan because it's 250 executives. 100 options each, and we don't know the share price and all. Okay, so but apparently it's material to the financial statement because it is for sufficient number of executives, and obviously it is related to the management and the senior positions. Okay, now share plan holds a good number of shares, and it is related to directors. Therefore, it is material to financial statements from qualitative aspect also, because it is for the executives. Okay, so normally executives refer to the executive director. So anything relating to directors is obviously material qualitatively also, and we don't know the value exactly. The reason being is we don't know the exercise price, and we don't know that what is the value of the shares at the grant date, because for equity settle you look at the fair value at the grant date. Okay. Now comes the last thing, the sale and lease back thing which they have done. Okay, so they have correctly de-recognized the property because obviously its life was 50 years, and then when they sold it, they only sold it for a 10-year period. Sorry, they sold it for 50 years and they leased it back for 10 years only. So that demonstrates that it was an actual sale because risk and rewards have been transferred. But they need to recognize the right to use asset for 10 years. It's not commented here. Okay, now, Carrigan Company should de-recognize the property sold under sale and leaseback arrangement, and then record its right to use asset for 10 years period. Okay, de-recognition is done correctly by Carrigan Company management, as when property was sold, its life was 50 years and it is leased back for 10 years only. Therefore, risk and rewards have been transferred. However, apparently, right to use asset is not recognized by Carrigan Company management because there is nothing written about it. So it's a risk or a probability that they haven't recognized it. So you have to recognize right to use asset at present value of lease payments because it's a right to use for 10 years old. Okay. If right to use asset is not recorded, it will understate profits and assets and liabilities. It will understate assets because it will be asset on one hand and liability on the other, and liabilities of Carrigan Company. Is there any valuation given? Again, the values are not given. Okay, so we don't know that whether by valuation it's material or not, but you can say that it was a high value property. It was in a sought after area with a high demand for a rental property. Okay, so this transaction may be material. This transaction may be material to financial statements of Carrigan Company if right to use asset exceeds materiality level of $3 million. See, this shows that sometimes you don't have the valuation. So this is how you make the commit. But apparently it will be more than $3 million because it was a big value property. As they said, it's in a sought after area. So ROMM, you wrote materiality level paragraph. Then you wrote risk. 5 good risk. How do we know, sir, these are good risks? Because examiner himself talked on them. Like here he told the company policy. Here he told about the management treatment of they don't know about what to do. And then here they are capitalizing it. Good risk. Then here they didn't recognize it, in the exhibit 4. So good accounting issues which were themselves referred by the examiner. Still, you can have a risk on import transactions also. Okay. And you can have a risk on bank loan thing also. You can have a risk on allowances for bad debt also. Okay. So 5 risk we wrote, 15 marks, 2 marks for materiality, 17, and 1 mark for these calculations. You can write a financial analysis also. Financial analysis is a good score where you do the ratio calculations and all. Now, every time you write risk of material misstatement or audit risk, you have to add a conclusion. This is not the conclusion of entire briefing paper. This is the conclusion of ROMM, in which we give the reasoning that which risk is significant. You can write it at the end of the answer also. The examiner permits it, and you can write it here also. I prefer writing here because things are fresh in mind. Like you give reasoning that which risk in your opinion was the most significant risk. Okay, so let's write a conclusion. Now, when you talk about the prioritization of the risk, obviously this is a judgmental area. So whatever you do, you can give a reason of it. Like obviously wrong revenue recognition policy is a big area. Okay, like if you're following a wrong recognition policy, it will be misstating the initial head, and this head also represents $80 million. Then the stores thing, these stores are of $171 million, their valuation, their presentation, that's also a big thing. Then intangible asset worth $6.5 million. For share-based and sale and leaseback, we don't know the valuation. So obviously we can't prioritize them exactly. Okay. So what I would say is that revenue recognition policy, either this can be first or the recognition of stores, this can be first. Both are acceptable. Both would be acceptable treatment. So first I change the sequence. Control X for cut and Control V for paste. Whatever risk is significant, you write that first, then the second and the third. You prioritize the first three only. So why not share-based and sale and leaseback? We don't know their values. So we can't include them in the valuation, in the prioritization. Okay. Stores acquired of ACIT represent a big value head of $171 million. Therefore, this risk is currently most significant one, as its wrong valuation and classification will affect financials the most. Okay. Second most significant risk is in relation to wrong revenue recognition policy used for maintenance plans, which represent 10% of revenue. Lastly, intangible assets also represent intangible assets issue of capitalization and their amortization is also a significant risk, as it represents value of $6.5 million. Okay. Normally, this prioritization is done on the basis of values, but it's not necessary. Like if it would be wrong revenue recognition policy over the entire company revenue, then maybe it would be the most major one. Maybe some related party transaction and a significant one would be most significant one. Sometimes while writing audit risk, new audit client becomes the most significant one. So don't restrict yourself that, okay, always value or always do like this. No. Always look at the scenario. So till now, this question has been an easy one, like for business risk. Now, one very important question. So you wrote acquisition of ACIT business here also, and then you wrote it in ROMM also. It's a repetition. No, it's not a repetition. The reasoning is different. Here, acquisition of ACIT was a business risk because the investment was not planned. There was a risk of investment failure. This is a business risk. But for ACIT business, valuation of stores is an accounting risk. Yes, it is possible that from same issue you get two risks. You get two risks. But business risk is from the perspective of profits or revenue or going concern or loss of investment, whereas ROMM is about financial statements, its valuation, its classification and all. So I believe that till here this question has been an easy one. Now let's move forward towards the last two requirements. Now comes the principal audit procedures to be performed in respect of sale and leaseback. Okay, 7 marks, so 7 procedures we have to write. Normally these procedure requirements are easy one. Okay, so let's look at it. So for the principal audit procedures in respect of sale and leaseback transaction, so let's go and read it again and then draft the 7 procedures in relation to it. Okay, so now we are talking about the audit procedures. Now audit procedures, some students always ask me that, sir, we are not very much comfortable in writing the procedures, so please guide us. For audit procedures, what you have to do is always think about the accounting treatment. Because at AAA level, normally the procedures are there to verify the accounting treatment that he gave you, the accounting issue of like IFRS 16, sale and leaseback. So think about the treatment that they have to de-recognize the asset, record its sale, then record the leaseback. So think about the treatment and put the procedures around it. Like let's look at it. On 31st March, Carrigan sold the property to a leasing company, coal company, for its fair value at that date. The property is situated in sought after area with a high demand for rental property. Coal company has assessed the remaining life of the property to be more than 50 years. And under the terms of the lease agreement, Carrigan will lease the property back for a period of 10 years. So now think about the procedures. You can have a surveyor or an expert report to verify this life of 50 years. Like how coal company assessed the life, they must got some survey done. Look at the lease agreement to verify the lease term of 10 years. Okay, then look at the non-current asset register, that asset is de-recognized correctly. Okay, then obviously when they sold it, they must have got some cash. So verify the bank statement to ensure that it was sold and the funds were received in the account. For right to use asset, because obviously you have to record the right to use asset. For right to use asset, look at the management calculations, because right to use asset is present value of lease payment. Look at the draft financial statement that right to use asset is correctly recorded or not. Let's just look at it how I draft the procedures. Since it's a procedure, so normally you start with the word review expert report through which coal company determined remaining life of property as 50 years. Okay, it needs to be matched with lease back period to ensure that risk and rewards of asset were transferred to coal company. See, whenever you write the procedure, what the procedure is, review expert report. This is what is the procedure. What will it verify? The remaining life. Okay, and what process you will follow? You will look at the expert report, you look at the lease back period. Since lease back is only of 10 years and remaining life is 50 years. So this is the reason why you are saying that, okay, the risk and rewards are transferred. If the remaining life would be like 11 years or 10 years and you leased it back also for 10 years, so in that case, risk and rewards won't be transferred. Okay, review bank statement to verify the sale price of building and match it with the amount recorded in financial statements. So to ensure that, okay, whether the sale is correctly recorded or not. Review lease back agreement to verify terms in relation to lease period like lease tenure and other responsibilities of Carrigan Company to ensure that risk and rewards are transferred to coal company. See, what are the procedures? You start with a verb. You start with a verb. You tell what you will be doing. Review lease agreement in relation to lease period. Okay, in relation to lease terms. In order to verify terms in relation to lease period, like lease period, it's repeated in relation to lease terms, like lease, to verify terms in relation to terms of lease, in relation to lease tenure and other responsibilities of carrying company. So what is the procedure? Review lease back agreement to verify terms in relation to lease. Okay, like in relation to lease, like lease tenure, for how many years it's the lease, like 10 years as they said. What are other responsibility like maintenance and all? Is there any buyback clause or not? Because these all things help you determine that whether the risk and rewards are transferred or not. Okay, then obtain extract of board minutes to verify that sale of property was authorized and its lease back for 10 years is approved and valid and validated from the board. Because management is saying that, okay, lease back period is 10 years. Maybe they have internally agreed that we'll continue renewing the lease. Okay. Then review non-current asset register to verify carrying value of property on sale date in order to verify that de-recognition of property is done at correct value. See, think about IFRS 16. Think about the accounting treatment. Okay. Then obtain management calculation of fair value, or I would say management calculation of value in use, in order to verify that it is correctly valued at present value of minimum lease payments. Okay, it need to be recalculated and its assumptions need to be verified through market data. Okay, now if someone will message me that, sir, I cannot think about the procedures, so I think that then he don't know IFRS 16, then he's not reading the issue correctly. Like, okay, they said life is 50 years. You will look at the expert report or surveyor report. It's sold, so look at the bank statement, look at the leaseback agreement, obtain board minute extract, review non-current asset register, obtain management calculation. So this is what you do. Look at the draft financial statements, that whether the asset is properly de-recognized, right to use asset is properly recognized, the gain on disposal is properly accounted for under IFRS 16. Because you know that the gain on disposal of sale and leaseback cannot be recognized immediately. It has to be spread over the lease period. Then also review that whether the right to use asset is correctly amortized or not. Okay. Review draft financial statements to verify that property is correctly de-recognized from financial statement, from carrying company financial statement. Additionally, gain on disposal is correctly recognized under IFRS 16 because it has to be spread, and right to use asset is recorded properly. So you take the draft FS to verify these things. See, when I talk about the procedures, like 7 mark 7 procedures, what you need to understand is that while you are writing the procedures, you have to keep the accounting treatment in mind. Because at skills level, in AA level, the procedures were around the assertions. The management claimed like valuation, accuracy, existence, because there the focus was not too much on the financial treatments, on the financial statement and accounting. But in AAA is very much interested on the accounting treatments. So the procedures go around that. Okay. like the value life. That's important for the classification of sale and leaseback. Bank statement, leaseback agreement, board minutes to verify, non-current asset register. Okay. Now comes the last requirement. Okay. Just a second. Now comes the last requirement, which is a 7 marks requirement. Matters to be considered in deciding whether Martin and Company should accept the engagement to provide advice on the sustainability information. So let's look at that. It's the last requirement of 7 marks. Now, so for this, we need to read Exhibit 5 first. Let's read it. It's a brief one. Now, the finance director has inquired whether Martin and Company can provide an additional service to advise management on how to measure certain social and environmental information which is to be published on the Carrigan website. The sustainability information is required by new regulations in the industry and must be submitted to regulatory authority. The social and environmental information relates to matters such as energy consumption, charitable donations, and initiatives which support diversity in the workplace. In recognition that work is quite urgent, as the deadline for submission to regulatory authority falls within the next month, the director is willing to pay an enhanced fees for the service. So I would say it's a normal requirement of factors to consider before accepting engagement, and something about ethics also. Strict deadlines, so there will be a lot of pressure. Willing to pay you enhanced fees. So maybe it will compromise your independence. And since we are an auditor, we can't involve ourselves in measurement things. It's a listed entity. And for listed entity, providing non-audit services is also not allowed. Then these charitable donations, these are already part of FS. So doing anything which is already part of the FS, it's a problem. We need to think about our competence also. Like, do we have competence to talk about energy consumption? Like these social and environmental things, auditor can provide assurance on it by looking at the evidence, but determining the measurement criteria is not always possible. Okay, so we need to think about the ethics thing, and I would say it's not a difficult 7 marks requirement, a routine one which we have seen a lot in the past, like something's offered in relation to non-audit services and all. So if we make a list of the points which we can include, so matters to be considered in deciding whether Martin and Company should accept the engagement to provide advice on Carrigan Company sustainability information. Okay, so first of all, you can say that it will create a self-review thread because a lot of information which is included in it, okay, on those information we are giving an audit opinion, like charitable donations are already part of FS. Okay, then fees, self-interest, like they are willing to pay us enhanced fees, so that we create a self-interest. Deadline pressure, like it's very urgent, so maybe we don't have time to do this in a fast manner. Maybe issue of competence issue. Okay, listed company, you cannot provide these services to listed company. Non-audit services to listed companies are normally not permitted. Okay, it's a listed company. And getting in anything involved which is about measurement is management responsibility. Okay, it's not the auditor responsibility to get involved in measurement, because they are looking at how to measure. Okay, not about the assurance thing. Okay, so in the matters to consider, not only you consider that, what actions you can do is, like you can consider using separate teams. Okay, consider using separate teams, or maybe these are the matters like a safeguard. You can use separate team, or you can have a discussion with the audit committee. Okay, you can look at the scope of the engagement. So it was more towards ethics because we were accepting something of our audit client. Self-review thread may be created if our firm provides advisory in relation to measurement of sustainability information, as our firm is also performing annual audit of Carrigan Company. Okay, lot of information included in sustainability report will also be part of financial statements on which our firm will give assurance. Okay. Additionally, one more thing. Additionally, it will be part of annual report on which auditor comments in other information paragraph of audit report. See, just think, if I'm including something in audit report, and then I'm involved in its measurement also. So it's like reviewing your own work. Self-interest threat may arise because, or if fees for this non-audit service is significant and creates our fees dependency on Carrigan Company. Finance director has indicated that they will be willing to pay enhanced fees for this engagement. It is possible that revenue involved in this engagement may compromise auditor independence or may compromise our firm independence for annual audit. Like maybe we are getting big chunk of money here. Okay. Annual audit of financial statements. We say, no, let's do bad thing in the annual audit, secure this work. Deadline pressure for this engagement may create issues for due care for our firm. Okay. In deadline pressure, maybe our firm is not able to provide professional services with sufficient quality. Okay, we need to have proper time. It will create intimidation during work, like do early for the work. Because if you take something which is high deadline pressure and you accepted it despite of knowing, so then they will say you should have thought it before accepting it. Okay, competence issue also needs to be considered. As our firm may not have expertise to measure, to advise on measurement of sustainability data like energy consumption. We are not that expert, or diversity issues. Okay, it may involve relevant experts to perform this engagement. So we need to consider all of these things. Carrigan Company is a listed company. And provision of non-audit services relating to financial statements, or I would say relating to financial data, is prohibited as per ethical code. Okay, our firm should politely decline for this service. Now, some students message me on very much routine. That's when you say politely decline, then why are you talking on other things? So do you want me to write only one statement and get 7 marks? Ethics is a guideline you discuss. You don't give judgments or decisions. Okay. Then, if our firm will get involved in measurement advisory, of sustainability information, it would be considered as accepting management responsibility from audit of financial statement perspective. Okay, auditor responsibility is to give assurance on management calculations and measurements rather than himself getting involved in measurement. See, measurement, valuation, classification, preparation, it's the management work. Like there is charitable donation, which will be part of FS, different initiatives, like any project or something, its financial thing may have been recorded in the financial statement. So we shouldn't be part of the preparation thing. Using separate teams to deal with ethical issues of independence can be one of the ethical safeguard which our firm can consider if services are to be provided. However, it is to note that if ethical issues cannot be reduced to acceptable level, then engagement should be politely declined. Now, very interestingly, one student messaged me a few days back that, sir, how do you know that you have to use the topic of ethics rather than client screening factors more? See, the topical demarcation is done by us, by the books. The examiner don't follow that. Examiner gives you a scenario. He says, you are an audit manager, answer it. Whatever topic you want to use, I don't care. So, and obviously, ethics is one of the important matter to consider, which need to be considered while accepting the engagement. If I look at this entire answer, I would believe that it would be a great luck, a good luck, if someone gets a question like this. What a lovely question. Now, someone will say that, sir, you spend 2 hours and 1 minute in solving it. In examination, we have to solve it in like 1 hour, 45 minutes. So how will we do it? You are the teacher, you were not able to do it. See, just close the requirement and give me an alone. I will solve it in at like 1 hour, 20 minutes. I was discussing also, I was reading the things also, I was teaching you also. Otherwise, it would have been easily done within time. It was a very easy question. Okay. So, practice of complete exam papers following the approach, not taking the exam pressure. Dealing with the paper in a relaxed manner, following the approach that how I have to write business risk, ROMM procedure, keeping the approach in the mind is the key to success in your examination. Okay. So in the next class, we'll be moving forward towards question number 2 and hope to see you all there. And if you have any query or you want any further support, you can always connect with me directly on my WhatsApp number. Okay. Thank you, everyone.